All right, futures higher after a big miss on that payrolls report. 30 minutes until the cash trade starts. I'm Katie Greifeld.
I'm Sonali Basak. Matt Miller is off today, and Bloomberg Open Interest starts right now.
All right, coming up, that jobs report shows a massive hit from storms and strikes. Next up on the horizon, the U.S. election and a Fed decision. We'll get the view from the White House, BlackRock, and PIMCO. Acting Labor Secretary Julie Su, Rick Rieder, and Tiffany Wilding join the show this morning. Plus, from big tech to big oil, we're wrapping up a busy week of earnings. Chevron CEO Mike Wirth joins us for a C-suite conversation later this hour. Let's take a look at where markets are trading, though. It's a busy one. Of course, we got Amazon and a few others last night. That was lifting the market pre-market, and we're holding those gains despite that whiff on the labor market report. You can see the S&P 500 currently up about 0.5%. Big tech also having a good morning after that wipeout that we've seen over the past week. The Nasdaq 100 currently higher by about 0.4%. And then you see the bond market. That's where things get interesting. It seems like bond traders taking that jobs report at face value, sending yields lower. The 10-year Treasury yield currently lower to the tune of 5 basis points, Sonali.
And less than a week from that FOMC meeting, Katie. Of course, what a way to end the week. Let's look under the hood here. Some movers to watch. Apple still trying to rebound from one of the longest sales slumps in history. Pre-market, Apple now down 1.8%, but as Katie was saying, not really shaking off that love for the Nasdaq 100 today. And what is helping it is Amazon, up almost 7% pre-market, reporting strong earnings, showing growth across cloud and retail divisions. Also taking a look here at Intel, up more than 6% pre-market, surging after a revenue forecast slightly above estimates, Katie.
All right. Meanwhile, we go back to the macro and we go back to that jobs report because U.S. hiring advancing at the slowest pace since October 2020. The non-farm payrolls report increasing just 12,000 in September, hit by, of course, both labor strikes and powerful storms. Let's bring in Bloomberg's Mike McKee now for a closer look and to talk about the weather because this was a noisy report.
Everybody talks about the weather. Nobody does anything about it. That's the old saying. Very noisy report. We did have 46,000 manufacturing jobs lost, and that fits with the Boeing strike and a strike at a Textron factory during the month. So that part makes sense, and we can figure that out. The unemployment rate, 4.1%. The BLS says that was not affected. The survey was not affected by the weather. Average hourly earnings probably a little higher because the lower paid workers are the ones who probably lost their jobs in the service industries. But the revisions certainly affecting what the number is this month and for the last couple months. But the most important thing is BLS says they can't quantify the hurricane impact on the establishment survey. They know it's there. The response rate to the survey was the lowest since 1991. So a lot of companies unable to send in their numbers, and they should show up next month. So expect big revisions next month. I'm not going to predict which direction, but expect big revisions next month. Otherwise, it kind of looks like normal in the report in terms of what actually happened because healthcare, state and local governments were the biggest job creators, which we have seen for months now, and most jobs lost. Manufacturing is explained by the weather, and then employment services, which could go either way. Could be because the economy is slowing, or it could be because people just couldn't report to work.
Even pretty quickly here, Mike, what about the revisions in particular? Let's harp on that for a second because the August revisions in particular were quite large. What does that mean for the Fed moving forward?
Really doesn't mean anything because at this point, it's what happened in October and what happened going forward. What happened back in August is sort of irrelevant to the Fed now that they've started a cutting cycle and gone forward. It maybe shows that they didn't need to do 50, but it's already done. So now we look at what the market thinks the Fed is going to do, and the market thinks the Fed is going to be basically unchanged with a quarter-point cut this next week. And then after that, it looks like you can see there's a little bit more strength for a greater cut in December, but we'll get another employment report before December's Fed meeting. So it's kind of not going to make a difference there.
All right, Bloomberg's Mike McKee. Really appreciate, of course, the context on what is a pretty shocking headline number on that jobs report. Let's continue the discussion now, because joining us is Acting Labor Secretary Julie Su, joining from Washington. Secretary, great to speak with you again today. I want to talk about the response rate. We were just having that conversation with Mike McKee. So just how low was the response rate, of course, in the wake of Hurricanes Helene and Milton, and when would you expect it to pick back up?
Yeah, so the overall picture of this economy remains one of strong, steady, stable growth. We have seen positive job growth every single month under this administration. And as you noted, there were a couple of big factors that make this last month an anomaly. There were the devastating hurricanes, which meant that there were jobs that people, businesses that were closed. We saw this because the federal government was on the ground working with state and local officials to do everything from the search and rescue to reopening roads to making sure people had access to water and to power. And so those same businesses that might have ramped up in the last month on hiring were not doing so. At the same time, the other big indicators are still really stable. Unemployment rate remains at 4.1%. We've said this again and again, that most predictors were that number could not go down to that for many, many years after the pandemic. And it's been steadily at near or below 4% for a very long time. GDP growth is up too. Wages continue to be up. Wages have outpaced inflation for 17 months straight. And so there are a couple factors that certainly we expected that they would affect the numbers for last month's report.
Well, Secretary, if we look at what wasn't as impacted by some of these effects that we're talking about on the weather, I mean, we still had big downward revisions to the September and August payrolls report. Obviously, this is going to be a bit of a noisy report. And looking ahead, I mean, you take a look to October or what we're going to get the next time around. How big would we expect those revisions to be?
Yeah, again, there were anomalous situations that affected this report, but even with those revisions in the prior couple months, the 3-month average, and we often look at averages because we don't want to make too much out of any one month. As you said, some of them can be noisy. The 3-month average for the prior 3 months is still 148,000 jobs grown in the economy. And again, if you look at overall indicators, people have been predicting a downturn for a long time in this economy, and it just has not. That's not what's happened, and that doesn't happen by accident. It happens because of steady leadership and again, the investments that we've made in America, in manufacturing, in construction, in clean energy, are having an effect, and that is one of the key reasons for the strength of the economy that we've had. Those investments will continue, and they are, that's part of the impact that we've seen over the last really 3.5 years.
The administration has guided that this would be a noisy report already, and of course this morning was indeed quite noisy. I want to go to the unemployment rate because one reason it did hold steady was the decrease in the labor force participation. If we can hone in there, how would you characterize the impact of the hurricanes in participation?
Right. I mean, as you noted earlier, we don't have granular data about that, but I think it's a rational conclusion that the impacts of the hurricanes were devastating. I mean, they were devastating to human life. They were devastating to those communities in the Southeast, but they also are showing up in the jobs report. Having said that, the overall labor force participation rate also remains, it's steady. It's at historic highs. So when we talk about the economy, we have to look at trends. And the trends overall on all major indicators, continue to signal an economy that's very strong. And there is nobody who's reassessing the overall health of the economy based on these numbers, which are really affected by a couple of things that happened last month. I'd
also love for you to go into the impact of the strikes as well. Obviously, the Boeing strike, as well as others, have impacted that manufacturing number, but the Boeing's latest union endorsed the latest offer. Do you expect there to be enough votes to approve the current deal and ultimately end the strike? And on what timeline?
Right. So I've said a lot of times collective bargaining works, and there is no better example of that than when workers at the bargaining table get an unprecedented offer, and where the demands that they've had, they get a chance to sit down at the table and help to shape the future of their jobs, the future of their employer, and the future of their industry. It is true that the tens of thousands of workers being on strike are also one reason for the jobs numbers that we see this month. And the workers will decide. They have been demanding makeup in wages and other working conditions for what's been over a decade of not having them, and so they now have an offer before them. And it was a privilege to help bring the parties together, to help move those talks along, and they'll vote on Monday.
And of course, Labor Secretary, you've of course been involved in ending other strikes. You're involved in these negotiations as well. We're counting down to that vote. What is still at issue here? Because of course, we've had a lot of conversations about wage increases. We know that there's been a lot of daylight between these two sides when it comes to the issues of pensions, for example. What is still left to be resolved right now?
I mean, these issues of retirement security, of benefits, making sure that workers can go to the doctor without breaking the bank, all of these things are fundamental to a good job. And in unions, workers usually have those things. They're not something that every worker gets to enjoy. And so at the bargaining table, all these issues come up. Again, these parties have not bargained for over a decade. And now that they've been able to do that, the workers have been able to surface issues that have been on their minds for a very long time, and they now have an offer that addresses the issues that they brought to the table. And I really need to give credit to both parties for coming to the table, for doing the hard work. These things are never easy. They often take all night. I've been at the table all night. This is the process of collective bargaining. It doesn't always look pretty from the outside, but we have seen the results time and time again, from auto workers to actors, all across the industry, where workers are seeing really historic gains. And that is a part of the picture of the overall economy. President Biden and Vice President Harris have said from day one, we can't build the economy that we want if we don't do right by working people. And the fact that wages continue to be up and wages exceed inflation are signs of that. Working families have more money in their pockets, and that's a good thing.
Our thanks to Acting Labor Secretary Julie Su. We do have to leave it there, but of course we are just days away from an election, days away from a Fed meeting here, and so ever critical of these data points. And of course a lot of movement in the bond market as well. A 2-year standing about 7 basis points lower at 410 on the heels of this report. And we're going to talk about that bond market next with Rick Rieder. He's BlackRock Chief Investment Officer of Global Fixed Income. Get a read on these job numbers from an investor's point of view. This is Bloomberg.
Welcome back to Open Interest. Take a check on futures right now, because you can see stocks inching higher. Of course, we had some good news from Amazon last night. That seems to be the driver in the equity market, at least after that jobs report. The S&P 500 up about 0.4%. Big tech, NASDAQ 100 up about 0.4% as well. Of course, recovering from that wipeout that we saw yesterday. An interesting thread here between the macro and the micro. Let's talk more about the macro right now and this morning's jobs data. We're going to do that with Rick Rieder. He is BlackRock Chief Investment Officer of Global Fixed Income. Rick, great to speak to you again. It is the first trading day of November, and it's interesting. You take a look at the reaction to that jobs report. Just 12,000 jobs added. We knew this was going to be a messy one, but it seems like the bond market is taking this at face value. Your 2-year Treasury yield down about 8 basis points. Do you think it should be taken at face value?
I do. I mean, listen, it's messy because the hurricane has already been well described. But even if you if you assume what the hurricane effect was, you get back to a number that's still showing some moderation in labor, and it keeps the door open for where the Fed. I think it's pretty clear they're going to cut rates in next week, and it also increases the probability of December, which I think they should do, and I think will play out. So I think you got to take some meaning in that. That being said, you got it. This is a payroll report. Sometimes there's a extraordinary focus on the payroll report, which there was somewhat today. But boy, between the UK budget, the election, earnings numbers that, quite frankly, give you a really good sense for revenue in the country and where growth is. So there's a lot going on. But I think you got to build into this. And maybe I'll throw out one last thing. I've said this on this show a bunch of times. The service economy, it keeps the economy. I mean, services just continue to hum along, manufacturing a weak number. But if you take the 3-month, 6-month manufacturing, they continue to be soggy. But it's the service economy of the U.S. that is super stable. And so I think their net takeaway is you got an economy that's still pretty good, at the margin. Softening a little bit allows the Fed to bring the funds rate down to 4%, and then you figure out where you go from there.
And that's your expectation for next week as well, that the Fed will cut rates. There's an open debate about December, but maybe we'll have that conversation next month, because I want to talk to you about what's going on at the long end of the Treasury curve. You take a look at 10-year yields. When we were having this conversation a month ago, you said something along the lines of, when it comes to the 10-year yield, we're probably close to fair value. We have moved up meaningfully since then. We were at 4% or so a month ago. Now we're at 4.25. What do you think is happening at the long end, and do you think this is a buying opportunity?
So I'll say a couple of things. We live in a context now where rates are pretty stable. I mean, it was a significant move in the 10-year point. And that being said, you think about where we've moved over the last couple of years, the last few years. Listen, I don't think there's a lot of money to be made in interest rates. I certainly don't think there's a lot of money to be made out the yield curve. I mean, if you look at total returns, if you recap October, a harsh performance in terms of the long end of the yield curve and what it did from a total return performance. And even though the front end came back, cheapened up a lot. I mean, we went from the lows where we were pricing DEES 25. We moved almost 100 basis points back. But then you look at the return, if you're an investor and say, gosh, how much did I lose? You actually didn't lose that much because you're just not running that much duration, not that much exposure. And this is part of why I really believe in this thesis. Like the back end, you don't really need to own the back end, just carry really well. And what happened this month that I think was extraordinary is now, I've said this before, we got our toys back. They priced hard landing last month, and now you got some cheapness, or you got certainly fair value and some real convexity in the front end of the curve. It allows you to build portfolios that clip 6.5% yield and just keep doing it over and over and over again. Listen, would I buy a lot of 10-year notes on this number? The answer is no. Would I buy some 10-year notes if we cheapen up a little bit? Probably not. I just love clipping yield in that front to the belly of the yield curve and just keep doing it month and month and month.
To the point that Katie was making on just how much we've drifted higher on the 10-year as well, and the confluence of factors that might be causing it, do you have an upper bound, a new upper bound where you think that this could be headed, especially knowing that traders are already looking for a potential breach of that 4 or 5 level, even headed to 5% in some cases?
So I think I'd like to figure out what happens on Tuesday. And I think I'd like to listen. I think the biggest issue and the biggest risk in the markets for the next year, 2 years, is going to be the size of the debt in the country. We got to issue an awful lot of debt. At the same point in time, that inflation, I would say most of the improvement in inflation has happened. Now you got base effects that aren't going to give you that much of a tailwind in terms of goods inflation. So listen, I just don't find it that intriguing to figure out. And by the way, I'll say it again, as I said last month. A 10-year note around 4%, we could debate, is it 4.25 or high 3s? Nominal GDP next year, we think will be about 4-ish, and put a standard deviation around that, given we don't know what policy is going to look like until we see the election results. But gosh, if you said nominal GDP is usually where the 10-year trades, and that's about where we are. And so could you back up a little bit more, given the amount of supply the Treasury has to issue? I think so. But so listen, could you migrate a bit higher? But I think we're about fair. And but like I say, I don't find it that intriguing. I just find the income really intriguing today, and you could build a ton of that.
Rick, a lot of people have been looking at the 10-year and looking at how much of it could be a Trump trade baked in. You mentioned elections. What are you watching on election night? What are the screens that you're going to have up? What are the assets, and how do you expect them to move?
I have a lot of screens up. Certainly my equity screens, my rate screens, my currency screens, my vol screens. We keep, and then what do you focus on? Listen, I think a big deal is going to be obviously where we end up in terms of the presidency, but I think the fabric of Congress is going to be a really big deal in terms of what is the mandate that whoever wins has. Listen, I think the Senate, it's still going to be, and I think at the net conclusion is you're still going to have a House that is still not going to allow the president either way to have a huge mandate because you're going to be so tight in the House. But I think some of these swing state numbers, obviously, in terms of what it means for presidency, but also for the Senate and the House, I think going to be a really big deal. So we're going to watch that really closely. Like I said, the biggest deal I'm focused on the next couple of years, who is going to address, or are they going to address, the debt and the deficits, and how aggressive will they be around it or not?
Right. Well, that's exactly where I wanted to go, so I'm glad you brought us there. Let's talk a little bit more about the deficit, because who knows what's going to happen next week. But no matter who wins, we know that the deficit is going higher. And sort of concerns about that fact has been used to explain what we're seeing at the long end of the yield curve. But I'll pose the question to you. Do you think that the deficit is an investable theme? Is that something that, when you look long term, that you're putting money to work around?
So I'd say first thing, I've said this before, I think you got to grow. I think in part of why I think the Fed's got to get the rate to a level that is a reasonable level, and I think 4 gets you to a reasonable level, and you pivot off of that, is A, you're creating a bifurcation in the economy between lower income and higher income, and I think you need to create more equilibrium. 2, I think you got to bring the cost of the debt down. I mean, the amount of bills we're issuing them front end at higher rates, we got to get that rate down. So part of why I like the front end is I just think it's a gift that because of where the rate is today, you can just keep building this income in a stable way. Listen, I think the other thing is we got to grow. The economy, U.S. economy, part of why the Fed has to get a rate down, you got to keep nominal GDP up. The only way you delever the economy is nominal GDP has to be above the cost of the debt. We got to keep growth going. And, when I look at payroll reports or dynamics like that, and you see in these earnings reports, top-line revenue is still pretty good, and it bifurcated across industry. Nominal GDP has to stay up. We got to bring the costs down, and then obviously we got to deal with things like entitlement spending, et cetera, to try and rein in some of these burgeoning costs at the government level.
Rick, at the end of the day, there's a lot of conversation about this issuance schedule. I'm glad you brought it up. And to your point here about the issuance at the front end, how long can that be supported? Because until now, people say the debt load, people say the deficit, but there's 2 camps here. One that believes you can keep going with the current status quo, maybe forever. But there's another camp that says something has to break.
So the camp that says we should still go, I'd love to get in a room and go through the data. Mm-hmm. Listen, I don't think you can keep going. I think at the end of the day, we have to, like I say, I think we should grow faster to outrun the debt, but I also think you have to have initiatives to deal with the debt. It's not sustainable at these levels. Debt service is not sustainable, and the size of the issuance, particularly in a world where the U.S. has to fund itself domestically. We used to be able to fund ourselves globally. That paradigm has changed. We know the dynamic with China is evolving, et cetera. Right. So I don't really agree with it. It can just keep going. Listen, I think as long as the Fed is moving down the rate, then I think we'll be able to fund a good deal of debt. But I think that's not going to happen for longer than a year or so. Right. And then then it becomes a tougher situation.
Rick, I have 30 seconds left with you, and I need to get your views on corporate credit, because you have this dynamic where yields are very high, but spreads are very tight. And for that reason, a lot of people say that corporate credit looks pretty rich right now. When you're taking a look at the corporate landscape, are you paying attention to that lofty yield or those very tight spreads?
The yield. I mean, the only reason we get these yields, default adjusted, you have more rising stars than fallen angels. You don't have a maturity wall that's been pushed out. And because the Fed's got the rate here, particularly in the front of the belly, you get these yields that companies, given default and not a maturing debt, they're super attractive. By the way, not just U.S., Europe, parts of Asia, which, Europe and Asia, you could swap back to dollars, right. You get more income from that. So there's no ambiguity in my mind. I'd like spreads to be wider, but these yields are pretty cool.
All right, you can't eat spreads, but you can eat yield. Rick Rieder of BlackRock, great to speak with you. The Market Open is up next. This is Bloomberg. All right, we are moments away from the start of trading on this first trading day of the month of November. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld, and you can see the pre-market action pretty good right now. Of course, we are sorting through a soup of earnings. We got a lot of big tech last night. We got a lot of big oil this morning. We're also trying to weigh that together with the macro. Of course, a miss on that jobs report in a big way. The U.S. adding just 12,000 jobs last month, well below the estimates of 100,000. At least that's good news, it seems, in the equity markets, deciding the Fed will cut rates next week. Will we get a decision on the president? Theoretically as well. In any case, you can see the bells ringing right now over at the NASDAQ, over at the New York Stock Exchange. Let's take a look, of course, at how the big indexes are faring just about 24 seconds into trading. Like I said, green on the screen from the S&P 500 up about 0.4%, even though you have Amazon up mightily right now after that knockout report last night. Big tech lagging a little bit. The NASDAQ 100 currently up about 0.3%. It's your small caps that are the biggest winner today. The little guys, of course, faring pretty nicely with the Russell 2000 up about 0.7%. The bet there, of course, is that this Fed is going to bring rates lower as maybe that labor market weakens. Let's take a look under the hood here. I mentioned big oil and Chevron topped earnings estimates for the third quarter as the company hits at potential job cuts as part of a new cost-cutting plan. We'll speak to CEO Mike Wirth in just a few minutes. And we also have to talk about Exxon because it also beat estimates driven by higher oil production in the Permian Basin. You can see shares up about 2%, Sonali.
That energy trade back on. Also watching your mighty Amazon over here, up more than 6.6% as the market opens. Apple is still trying to rebound from one of the longest sales slump in history. It provided a tepid forecast, down about 1.7% right now. Not enough to drag the NASDAQ 100 down. But Amazon's strong earnings had shown growth across cloud and retail divisions. Not the only cloud stock higher today either. Let's flip up the board here. Take a look at Intel because it is surging. After providing a revenue forecast slightly above estimates, the company is working, of course, on a very long-awaited turnaround plan to cut jobs, spending, potentially spin off some businesses here. Intel shares up a surprise 5% in the market as it opens. Now, Intel CEO Pat Gelsinger joined Bloomberg last night to discuss.
We don't view any of these rumors as particularly meritorious. We laid out a strategy. We reaffirmed that with our board of directors. And obviously, as we've taken these steps this quarter and restructuring and getting our costs where they need to be, we have the capacity to go on the journey.
Bloomberg's Ed Ludlow conducted that interview, and I'm pleased to say that Ed joins us now from San Francisco. And Ed, you think about what companies really needed to show up on earnings day, and Intel, of course, would be among them.
Well, Intel's problems are their problems, it's very specific to them. But the rumors that Gelsinger was addressing there were, of course, the reports that Qualcomm and ARM were interested in buying some or all of the company. We had to ask him that explicitly, right? And that was his answer. But the rally in the shares this Friday, I probably as much relief as anything else, right? They took very painful decisions in the quarter gone that manifested themselves in impairment charges, and therefore there was a much wider bottom line miss than expected. But yes, in the final 3 months of this year, there are little signals that they might be turning a corner, little signals, because there's still a lot wrong there.
I want to switch gears here and also talk a little bit to you about what we know now after all is said and done from so much of the Magnificent Seven earnings period.
Right.
There were clear winners, weren't there?
Yeah, I think it's the idea that nothing's changed in their commitment to capital expenditures. Amazon is a consumer company in many ways because of Amazon.com and its retail businesses. But the cash cow in operating income context is AWS. And so when you look at their guide for the final 3 months of this year, you guys describe them as mighty or mightily. But you have to remember they went through a sustained period of sluggish growth with AWS, the cloud unit. That's now returning. 19% top line in the quarter gone. Reading between the lines in the quarter to come, they are returning to a position of strength where the spending is resulting in returns. Revenue specifically tied to AI offerings, be it software platforms or specific tools.
And you always like to see that, of course, a return on your investment, if you will. And after, of course, this week of earnings that we just lived through, talk to us about the competitive landscape in the cloud. Of course, AWS mighty there. Microsoft disappointing a little bit when it came to the growth projections. And then Alphabet out with a surprisingly strong report earlier this week.
Yeah, the state of play, right, is that Amazon is the market leader. AWS is number 1, Microsoft Azure is number 2, and Google Cloud Platform is number 3. And after Google and Microsoft posted their prints, there was some evidence that they had taken market share from Amazon in the quarter gone. Then AWS gave us some growth. You know, it's going to take time to see how that plays out long term. The principal difference with Microsoft is that the bar was very high. They went from 34% cloud growth in the quarter gone to telling us there will be about 31, 32% growth in this current period. You know, 31 or 32%, like any company in the world would be like, yeah, I'll take it. But the bar is high from investors because of just how significant the spending commitment is from all three. And also put the AI bit to one side. If anyone can anywhere in the world, just put it to one side. There are other things you can do with cloud computing, storage, running other software platforms. So the dynamics between the three will be closely tracked from this point.
Ed, we thank you so very much for breaking it all down for us. Of course, it was a very busy week. I hope you get some rest until another type of busy week ahead. We're going to dive more into the markets now with Bloomberg's Jess Menton. You know, it's really interesting. You are coming off of a tough month of October. You're walking into a bid into September. You have to ask if this bid is a strong one, given it was off the heels of tough jobs numbers. What are you seeing out there?
So it was tough, but actually at a certain point up until yesterday, though, obviously with yesterday's declines, but in October, usually it's known as the most volatile month compared to the other 11 months if you go back through history, but actually bucked that trend this past month, kind of like what we would have seen in September, usually the worst month, but the S&P 500 was higher about 2%. But actually yesterday, the S&P 500 snapped its longest streak of comp since 2021. So it actually went 29 sessions without a decline of more than 1%, which obviously that ended up happening yesterday, but obviously we're going into a pivotal week next week with the election, Fed decision, earnings obviously continuing, and then we do have a looming 13F deadline coming up too. But when you look overall for earnings, when you actually exclude energy companies, S&P 500 earnings growth actually double digits. It's around 10%. So those pre-estimates for earnings season were about 4%. If you look overall, it's around 7%. But it's really because of more of the commodities-related type companies. Obviously, we had Exxon and Chevron report earlier today, but really a lot of that drag is due to energy. Well, let's talk about that a little bit more. Of course, we'll be speaking to the Exxon CEO, Mike Wirth, or Chevron rather, in just a couple minutes. We also had Exxon this morning. We have Halliburton next week. I mean, talk to us a little bit more about what's going on in that sector that's actually dragging down the index. Well, in particular, because of the third quarter, how if you look at WTI or Brent prices, obviously they were down about double digits. So that was what was weighing on that. It's interesting, though, because if you look overall, it's close to about 30% contraction if you look for the energy sector overall for the third quarter year-over-year basis. But obviously a lot of that is tied to commodity type prices. Also, materials is another sector that is expected to underperform. But of course, overall, if you look at growth, it's supposed to still be driven by tech, communication services. But specifically, when you're looking at that next week, as you mentioned, we will have Halliburton. We just had Schlumberger report a couple weeks ago, obviously the world's largest oilfield service provider. But earlier this summer, they both saw strong demand. But from Schlumberger, they did indicate that when it came to spending, we're seeing a slowdown in that. So that's going to be key to look at Halliburton next week, even though we did get a little bit of bright spots today from Chevron and Exxon. Yeah, which is interesting, of course, because you think about the big oil majors, Exxon, Chevron, oil prices have just been going down and down. Jess Menton, got to leave it there. Really appreciate you. Of course, happy Friday. That is Bloomberg's Jess Menton. And coming up, as we were just saying, Chevron's Mike Wirth joins the show on the heels of its earnings report. That conversation coming up next. This is Bloomberg. All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, Wells Fargo lowering its price target on Meta to $641 from $652, keeping that overweight rating, though, citing increased conviction in its above consensus 2025 revenue growth estimate. Next up, you have JP Morgan raising its price target on Peloton to $7. That's from $5. Keeps its neutral rating, though. The firm says that expense savings are materializing faster than expected. And finally, we have Cinemark downgraded to neutral from outperform at Wedbush, which writes that the theater operator is priced for perfection. The Firm's price target is $32. Meanwhile, let's head over to big oil. Of course, earnings out this morning for Chevron, beating. That is fueling a stock rally, as you can see. The oil giant reporting that it saw a production boost from the Permian Basin. It also announced a new cost-cutting plan. Chevron targeting a $3 billion savings, which could include job cuts. Joining us now for more is Mike Wirth. He is the CEO of Chevron. Mike, it's great to speak to you today. And I want to talk about the fact that, of course, you did beat estimates. The Permian Basin, obviously a bright spot there. But then there's the fact that West Texas crude, for example, can't seem to reliably break above $70 per barrel. As we read, of course, you are planning cost cuts. But how do you thread the needle between bringing those costs down without sacrificing margins too much?
Well, Katie, it's good to be with you this morning, and we did report a good quarter. We had strong operational and financial results. We started up some key projects in the Gulf of Mexico, and we returned record cash to shareholders. In fact, production was the highest third quarter ever in the history of our company. It was the highest U.S. production we've ever seen and highest production in the Permian. We started a big new project in the deepwater Gulf of Mexico and have more to follow. We're going to increase production there from 200,000 barrels a day to 300,000 barrels a day by 2026, and over $7.5 billion returned to shareholders through our dividend and share repurchase program. In a commodity business, we need to be prepared for cycles. And so capital discipline always matters, cost discipline always matters, and we can't control commodity price, and it's very difficult to anticipate commodity price. So we have to prepare for down cycles. WTI and, frankly, all the different commodities across our sector right now are seeing some pressure, but that's inherent in our business, and we're ready for that. We're built to win in any price environment with downside resilience and upside leverage.
All right, built to win. Let's talk a little bit more about the Permian Basin. It was interesting to see that your production there hit a new quarterly record. I know that you have a target for 1 million barrels per day from the Permian. When next year do you anticipate that you could hit that?
Well, any monthly or quarterly production is a function of drilling activity and when you bring wells online. We've got a strong track record here. We've grown the Permian production at a 15% compound annual growth rate over the last 3 full years. I expect we'll be up even more than that here in 2024. In the quarter we just completed, we were at 950,000 barrels a day, and so it's very, very clear that we'll reach 1 million barrels a day. It doesn't matter that much which month that occurs in or which quarter. We're on a strong ramp towards that. And the key thing is we're getting more efficient in everything that we do. We get better growth and better response for every dollar of capital that we spend. We're investing in new technologies that allow us to produce more out of every well that we drill. And so all of that accrues stronger margins, irrespective of the price environment, than we otherwise would have had. And one differentiating thing about the portfolio that we have in the Permian is across most of our acreage, we have zero or very low royalties that are payable to others because we own most of that property, which is a bit unique. And so you put all that together, and the Permian's a critical asset for our company and drives strong returns and a big part of the free cash flow growth story.
I also want to go to efficiency a little more. I know you've told analysts that cost efficiency is near to your heart, and you have flagged possible job cuts in the latest plan to reduce costs as well. I know that there could be asset sales as well. You mentioned new technology, but as it pertains to jobs in particular, how should investors, employees be thinking about how many jobs could be reduced in the United States?
Well, I think it's premature to speculate that. What we've talked about is $2 to $3 billion in structural cost reductions over the next couple of years. Some of that will come from portfolio actions where we take cost out and move some assets out of the portfolio. A good portion of that will come from productivity improvements and the application of technology to do things at lower cost. Some of it will come out of our supply chains, and then some of it will come from changes in how and where we execute work. That is where it could impact people, but it's early for us to be very definitive about that. We've got work underway to define that. As those projects and that work is further along, we'll speak more about that first and most importantly to our workforce and then to investors. So I would say stay tuned, but don't read the the intent to continue to become more cost efficient, which is inherent in a commodity business and something you can never step away from as only being about jobs. It's about much, much more than that, and jobs are a small part of the total.
I want to also ask you about the capital return plans here, because the decision to tap into debt to return money to investors through the form of buybacks, how long can you maintain the current buyback schedule, and what's the optimum debt level for you to take on in order to do so, especially in the face of volatile oil prices?
Sure. So we can sustain the current level of distributions for a long time. We've got a disciplined set of financial priorities that we've had for decades. First and foremost, to grow the dividend, and we've done that for 37 consecutive years. We haven't cut our dividend since the Great Depression. The second is to reinvest cash flows to grow future cash flows. The third is to maintain a strong balance sheet, which I'll come back to. And the fourth is to return excess cash to shareholders once we've satisfied those first three needs. 16 of the last 21 years, we've returned cash through share repurchases, very consistent and ratable program, not only when times are good, but through the cycle. And we're very under-levered at this point. Our net debt ratio right now is less than 12%. In the fourth quarter, it's likely to go down even further as we complete some asset sales and continue to see strong cash flow generation in our core business. Could be back down into the single digits. Through the cycle, we've guided to a range of 20 to 25% net debt as something that we think is appropriate to maintain the strong AA credit rating that we currently have. And so in a commodity business, there are times when your cash flow is in excess of your dividends, your capital, and your share repurchase needs. There's other times when it doesn't meet those, which is why you have a very strong balance sheet and a lot of capacity so that you can stay consistent through these cycles, which is what our track record has demonstrated and certainly what our commitment to our shareholders is.
And Mike, I just counted again. We're 4 days away from the presidential election. So, of course, I have to ask you a little bit about policy here, because when Americans head to the polls, I'm curious, what's at stake for the U.S. energy industry? What's at stake specifically for Chevron, especially when you think about long-term investment decisions that you might be making?
Well, the most important thing for a long cycle business like ours, where we allocate capital over years and decades and have assets that operate for many decades, is to try to seek some consistency in energy policy and to try to help shape policy that balances economic competitiveness and prosperity with energy security and with environmental protection, and not to over-index on any one of those at the expense of the others. And so good policy is balanced. It encourages investment to keep our economy strong, to keep our economy secure, and to protect the environment. And so whatever the outcome of the election, those are the messages that we will take to the new administration, and we'll sit down and engage on things that we think are good for the U.S. economy and allow us to continue to invest in this country.
Appreciate the context there. I do also want to talk about your share price. I mean, it's not just Chevron. It feels like the entire energy industry really trades at a discount relative to some of the other sectors in the S&P 500, such as big tech. And that's on the cusp of course, record oil production in a lot of cases. Of course, the progress that you're making in the Permian, for example. What do you think investors are missing about the energy story or not appreciating?
Well, I think your point's a very good one. Our weighting in the S&P is roughly half of our earnings or cash contribution to the S&P. And so multiples and valuations in the sector are low. I think a decade ago, that was a function of the fact that there wasn't a lot of cash being returned to shareholders by many companies. Most of the cash or all of the cash was being reinvested in growth. I think the industry has changed. We don't see that condition today. We see companies that have become much more disciplined, that have robust dividend and share repurchase histories now that they're building. Ours has gone back over many decades, but the industry has, I think, now begun to exhibit those same characteristics, and I think shareholders are beginning to take another look. The other question I think that has weighed on the market has been the duration of future cash flows. A lot of talk and a lot of interest and commitment to evolving the energy system to one that's a lower carbon energy system. But what I think investors haven't fully grasped is that doesn't mean that the age of oil and gas is ending anytime soon. Hydrocarbons represent more than 80% of global energy supply today, roughly the same number that they did 20 years ago. And as you look out many decades into the future, that mix may change, but it will change slowly. And that's against the backdrop of an energy demand that will continue to grow. And so the duration of these cash flows are much longer than I think they're being discounted into the valuations of the stock. And it's a real opportunity for investors to reweight into the sector with the strongest companies. And we're beginning to see some of that, but I think there's a long way to go.
All right, Mike, that feels like a good place to leave it. Really appreciate you taking the time to speak to us this morning. That is Chevron CEO Mike Wirth. This is Bloomberg. Welcome back to Bloomberg Open Interest. A quick check on the broader market right now because we have gains building at the index level. The S&P 500 up about 0.8%. The same thing, too, if you take a look at the NASDAQ 100. Your small caps are the winner, at least for right now. The Russell 2000 currently up about 1.2%. But it feels like all the action is under the hood right now.
There are so many individual movers. I want to take a look at some that are moving bigly, as you guys like to say. Sitting in Matt's seat, taking his words, Wayfair down more than 4%. I think that's interesting because people have been watching those consumer-focused stocks. Atlassian up 15%. Charter Communications up almost the same amount. It's earnings season, of course, but interesting things happening in tech, media, and telecom, Katie. Also quickly watching Boeing here as well. Supermicro, DJT. Listen, Supermicro, I don't know if you heard this. They're reporting on Election Day.
Oh, my God. Burying that report.
Right.
It seems like, of course, a really tough go for Supermicro, of course, and Boeing making some progress on those labor negotiations. Up next, we'll be speaking about the jobs market with PIMCO's Tiffany Wilding. Great lineup. Don't go anywhere. This is Bloomberg.
We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Sonali Basak.
And I'm Danny Berger. Stepping in for Katie Greifeld this hour. Matt Miller is off today.
Let's get a check on these markets. They had been ripping to start the day. You have the S&P 500 now up about 0.8%. NASDAQ 100 also holding those gains, 0.8% higher. The 10-year yield has been fluctuating just a bit throughout the day. Of course, we had that jobs data this morning. You saw a bigger move over in the 2-year, but the 10-year, you see a move downward about 1 basis point, almost 2 basis points out at 426. Big jobs week ahead. And Danny, I think we have some data coming through the wire as well.
We do indeed. We have ISM manufacturing data crossing the terminal right now. Those figures, let's bring in Bloomberg's Mike McKee, who has a look. Mike.
After lots of good news, we've got the black cat crossing in front of us right now. Manufacturing PMI comes in at 46.5. That's down from 47.2. Economists had expected a slight rise to 47.6. Instead, we get a lower number. Prices paid rises 54.8 from 48.3. So that's a significant change. The production numbers are down 46.2 from 49.8. Employment down. Employment actually rose. Now, that's kind of interesting after the fact that we got this manufacturing loss of 46,000 jobs. But the employment number went up in the ISM manufacturing number. And then inventories are a little bit lower, 42.6. That at least jives with what we saw in the trade report. But the prices number is not good. It doesn't seem to have figured into the latest inflation data, though. And the overall new orders and employment numbers not particularly good either. So it's not a cheerful report. But again, I think the Fed probably looks through this.
To that end also, you're seeing just a minute reaction in the bond market. The 2-year up just a little bit. It had fallen quite meaningfully after that jobs report. You mentioned the manufacturing data and kind of the choppiness as it pertains to what you saw in the jobs report this morning. How do you put the two together now?
Well, it's kind of hard to put the two together in terms of the employment numbers, but you put the two together, and the story that is being told is that the economy is slowing. Now, it is not slowing into recession territory. We've had the ISM number down below 50 for about 18 months now, whereas the payroll numbers if you leave out the weather impact and you figure that we're probably around 100,000 or more for the month we'll see next month, then that's what the Fed expected to see. And that's not worse than they anticipated. They can't really make a decision based on the November payroll or October payrolls numbers. So they'll probably just go with what they're already thinking about the economy. And the retail part of it, the economy has been good.
Mike, we thank you so much for everything you've done for us this morning, which is a whole lot. That is Bloomberg Michael McKee. There's been certainly a lot of data this Friday. And joining us now to parse through it all is PIMCO economist Tiffany Wilding. And the point that Mike was making here about the idea of a slower growing economy, about the idea here that there were very messy numbers this morning coming out of the jobs report, and the manufacturing sector in particular has been week. How do you think about the path forward as it pertains to what the Fed's next moves might be?
Yeah, well, so I think today's report in some sense was a little bit Goldilocks if you smooth through the noise, because even if you look past some of these one-off factors that Mike pointed out, the labor market is slowing. Call it a little over 100,000 jobs created, excluding those one-off factors. Isn't great. And ultimately what we've been arguing is the U.S. economy is just gradually slowing and normalizing, but it's not crashing after the, post-pandemic period that's just been quite unique. And ultimately that slowing is probably healthy, and it's getting us back to some semblance of normal. So, I think in that kind of environment, you still have a Federal Reserve, which is on track to gradually reduce interest rates. Interest rates are the thing, I think, at least the policy rate is the thing that kind of stands out as still being in that extraordinary territory. Federal Reserve understands this, and I think they are on track to deliver, a sequence of cuts to see how the economy responds to that and to get us back into more normal territory as well on the policy rate.
Tiffany, I know you guys parse this very closely over at PIMCO, these jobs numbers line by line. And if you think about, in particular, the revisions, they were a lot. How did you read them?
Yeah, so certainly the revisions were, I think, a weak part of this report. And it does suggest, I think, that the labor markets are continuing to cool, that job growth is slowing down. If you look at the unrounded unemployment rate, it did rise. It almost rounded up to 4.2. So, and the participation rate fell. If the participation rate hadn't have fallen, you would have had an unemployment rate up at 4.3. So the broader point that we would just make is that we do think you're seeing just a gradual increase in the unemployment rate, but the economy is not crashing. Growth is still very robust. And we're just getting into just a more normal environment. We've had a surge in immigration over the past several years as those folks integrate into the labor market. It's possible we could see a further gradual increase in the unemployment rate. But ultimately, we think things are okay. And ultimately, this is a healthy type of transition.
Tiffany, it's a touch of narrative whiplash yet again, because the conversation for the past month had been really strong data putting the Fed on pause. Does this month's data do enough to get that conversation out of the way? Is this a Fed maybe not on autopilot, but something close to it with delivering cuts?
Well, I think that the next week's 25 basis point rate cut, I think that's pretty certain at this point that they're going to deliver that. I think there's more of a question around December, but still getting a cut in December is our base case. And I think it's reasonable for the Fed to just do a sequence of cuts here and see how the economy responds. There is uncertainty around the outlook and how monetary policy impacts that, and they want to try to gauge that. It's difficult with 25 basis points or even 75 to get a good sense. If you cut 100 basis points, you start to see how the economy responds. You get a better sense for where policy should be in more normal territory. I think that's ultimately what they're trying to do here, and that suggests us there's a pretty high bar at this point, at least, to kind of knock them off that path. Certainly we have an election next week with potential for some meaningful economic policy, pivots. So that will obviously something they'll be factoring in as well. But nevertheless, we think across a range of economic scenarios, there's room for the policy rate to come down here.
Tiffany, in next week's meeting, how do they even factor in the politics? Because it might be a meeting where we still don't even know who the next American president is.
Yeah, well, I think they're going to they'll still we think they still announce a 25 basis point rate cut, and they will still point to the fact that inflation has come down, and that they feel better or more confident that inflation will continue to come down because labor market imbalances have completely normalized since post-pandemic. Layer on top of that, the U.S. economy has been pretty productive. We've been able to have pretty elevated productivity growth, which has also helped bring inflation down. So the Fed has to be, ultimately pretty good about this, feeling pretty good about the soft landing. They'll be focused on sticking the soft landing, but they also have to be flexible, knowing that the presidential election, could be impactful. So I think they will keep a cautious stance. They will focus on the fact that inflation's come down. We look at more normalized conditions, and the policy rate also needs to come down.
I want to ask about a specific sector of the economy because, everyone has known that manufacturing has lagged. It's been a weak area to look when you look at jobs and when you look at other economic data. But when it comes to services, when it comes to consumer spending, when it comes to these areas that you're still seeing strength, how strong is what I have to ask? Because at what point do you worry about the consumer rolling over and then not being able to spend on services?
Yeah, well, we think on average the consumer in the United States is doing okay. Certainly there are pockets of weakness. Obviously the economic statistics are focused on the average consumer. We also like to look at the distribution underlying that average. The lower income consumers are definitely under more pain here. They're suffering under higher rental prices, food, energy. Their wages have gone up, but overall there's been a negative net real income shock since the pandemic for many people. On the other side of that, you have the middle to higher income that is doing okay. They're really the ones that are carrying this economy. And, I would just say that they're carrying not only the U.S. economy, but the U.S. consumer. It looks like a really strong point across the global economy as well. And I think part of the reason for that is just the pandemic-related stimulus. We came out of the pandemic-related recession with consumer and private sector balance sheets looking stronger than they did before the recession. That just usually doesn't happen. And so that's really set the consumer up to be a pretty solid piece of the economy here.
Tiffany, this was great. We really appreciate it. PIMCO's Tiffany Wilding there. Okay, coming up, car parts king Magna International revving up despite cutting its full-year sales forecast. We're going to speak to the company's CEO up next. This is Bloomberg.
And now to high interest, to look at what's making headlines around the world. The World Series proved to be a ratings victory for Fox Sports. It saw an average of 15.8 million people tuning in each night to watch the Dodgers defeat the Yankees over the 5-game series. The series registered the highest rating since 2017. And also turning now to politics because Lazard President Ray McGuire may finally have his political moment. Those closest to the Vice President, Harris, say that he's a top contender for a cabinet appointment, potentially even Treasury Secretary, which is actually just one of 2 cabinet positions to have never been held by a black person. And it seems that Treasury Secretary Yellen has found her mini-me this Halloween, writing in a post on X, a frank and productive exchange of views with my counterpart on key issues like expanding the global supply of candy and toys and tightening sanctions against chores, Danny. I certainly tightened those sanctions myself at my house.
I am so obsessed. Also, Sonali, I'm going to start a campaign. Dress your daughters up as economists. I love this. Let's do it.
Absolutely.
And the gold, the necklace, all of it, it is perfect. Okay, on to more serious matters this morning. Shares of Magna are on the rise today. The company announced it would be resuming its share buybacks in the fourth quarter. However, it did cut its full-year sales guidance. Here with us with more is Swamy Kotagiri, Magna International CEO. Magna is one of the world's largest automotive suppliers, covering nearly every part of a vehicle. Everything from powertrains to car seats. Swamy, wonderful to see you this morning. I know you cut your full-year outlook, but the market is positive on this one. Analysts saying that you are controlling what you can control. In a tough macro environment for autos and auto parts, what levers can you pull on at this moment to navigate it?
First of all, good morning, and thanks for having me. I would like to step back and say we always like to look at the business as a long-term stewards, and that's where we are always focused. we are focused on, given the uncertainty and all the headwinds and the challenges, to say the least, automotive is a very dynamic industry. And with all the things that are happening, our focus truly has been on operational efficiency, margin expansion, free cash flow generation, and capital discipline. With all the operational initiatives that we have had, we've been able to deliver a good quarter. But if you step back and look at it, yes, you're right. The forecast in terms of revenue has been lowered in line with what's happening with the overall industry. But with that said, what we said in February was a EBIT range of 5.4 to 6. We are still holding and staying in the range. More importantly, we have been able to hold the free cash flow margin that we talked about in February. And with all the initiatives and discipline I talked about and the levers that you mentioned are being able to prioritize and be flexible and react to the environment today and reduce capital by about $300 million. And again, looking at what's happening and being able to prioritize, we reduced our engineering R&D spend by about $100 million or so. This is what's kind of adding up to be able to deliver the results, but most importantly, have a little bit of visibility into 25 and 26 now. And with the conviction that we have in our initiatives, in the free cash flow that we see coming, we have restarted our share repurchase program, which has been a staple for Magna if you look at the last decade or so. So we are really excited about that and want to show our conviction to our shareholders.
You can have conviction in the company, but Swamy, for the industry outlook, how cloudy is it right now? How much certainty can you have on the type of demand environment that we will be facing in 2025 with so much event risk and different headwinds?
Yeah, we would all like to get that certainty, as you said. But I think we have a good view. We look at the releases, we look at the planning volumes, we look at the inventory in the market, we look at how the models are doing on the platforms and programs that we are on, and we flex our variables that we have under control in our operational activity. But still, that leaves a certain amount of macroeconomic uncertainty. The interest rates are coming down. That hopefully should help the consumer sentiment. But what's happening in the industry today, the only thing that we can do is be flexible, be resilient, and be ready to react. And like I said, focus on the variables that we control.
Speaking of variables that you can control, I want to speak to your buyback plan here as well and the ability to really return capital to shareholders. How far can this plan go headed into next year with the uncertainties that we were just talking about here? And do you see any room for upside heading into 2025, again, even with those uncertainties?
Yeah, absolutely. What we have had is a very good roadmap in terms of operational initiatives, and we talked about having a 75 basis point margin expansion over 2 years in 24 and 25. We hit what we needed to hit in 24, so there is enough roadway left into 25 that should act as tailwinds. That's one aspect of it. We have taken a very modest assumptions for vehicle volumes going into 25. So I would say that's very realistic from what we are seeing today. If you put all of this together, we feel confident in the free cash flow, that's coming through. That should help our share repurchase. We talked about up to a 10% of our float for the buyback. And if you look at it, we're going to start the repurchase program in the Q4 this year. And obviously, we'll look at all the metrics, macroeconomics, how the industry is doing, and so on and so forth. But we've always been guided by a very a clear strategy and capital allocation and balance sheet. We are very focused on retaining an investment grade rating, given the cyclicity of the industry and what happens with all the uncertainty. It's a good balance that we have in place for returning capital to the shareholders, but also having enough liquidity to have the business running, without any interruptions.
When you look across the auto industry, everywhere you look, most companies are having one challenge or another, whether you're Stellantis or VW or Ford. And when you think about on the client side, when you're watching your clients face, one-off troubles in different parts of their business, frankly, how are you thinking about how you navigate that?
Yeah, I would like to go back to what I said. some guiding principles. We say we always look at business as long-term stewards, right? We are focused on the product lines that we believe we have a relevant position, or we have a clear roadmap to have a relevant position. We look at the product lines, good market share, also look at how they're proceeding into the future, that the profit pools are expanding. That's one side of it. And now we step back and say, how did we perform in the last 2 decades, right? If you go back to 2004, North American volumes were like 15.5 million roughly. We are 15.5 million today. Magna was half the size that it is today in 2004. My point here is we have gone through various cycles of this. As customers change their market share, we've been able to expand by increasing our content per vehicle or to start participating with new customers. We went into China. We started off with the Western OEMs, pretty much being a lion's share of our revenue. Now we have started getting a significant push into the Chinese OEMs. So our revenue is roughly about $7 billion there, half and half between select Chinese OEMs and Western OEMs. All of this put together is how we continue to grow in like what I described as a very dynamic auto industry.
Swamy Kotagiri of Magna International, we thank you so very much for your time, of course, in a challenging season. But of course, the shares up today on the promise of those buybacks and navigating this environment. There's still ahead another challenging situation. Boeing and union leaders, they reach a tentative agreement to end a lengthy strike. We've got the latest on those talks next. This is Bloomberg.
Let's get you some social climbers. The company is making waves this morning. First up, Boeing, union leaders there, and the company reaching a tentative deal to end the ongoing strikes. It would boost wages by 38% over 4 years, give workers a $12,000 signing bonus. If approved, workers will vote on that measure on Monday. Next up, Wayfair posting an earnings beat. That's despite continued challenging market environments. The CEO says that home goods company remains laser focused on delivering healthy profitability. Finally, Atlassian soaring. The cloud growth there impressing investors. The enterprise software developer forecasts revenue for its fiscal second quarter ahead of expectations. It also beat on first quarter earnings. An analyst at KeyBank notes that Atlassian has cleared a high bar. Sonali.
We're going to get a check on these markets, of course, now, Danny, as well, because it's fascinating. You are seeing the S&P up even more now, more than 1%. The NASDAQ 100 up by 1.2% now. Just a very strong bid. But what's fascinating to me is even though you've seen that fall off in the 2-year, you're actually seeing a rise back in the 10-year, back above 430. Would not have put that on my bingo card this morning.
Certainly not. It just speaks to the volatility of this bond market and the nerves of investors. The MOVE index is at its highest in about a year heading into this election. How much does the data really matter? Do we need to look through this report? Because at risk is an election and an expanding fiscal deficit.
And for the rest of the show, we'll talk about the markets, but to your point, we'll talk about it pretty much only in the vein of this election cycle. A lot more on that ahead. We're going to have some great conversations here, especially on those election betting markets. We're going to speak to Tarek Mansour. He's the CEO of Kalshi, which is very much in the United States. Interesting odds out there. That's next. This is Bloomberg.
We have just 4 days until the presidential election. Both candidates heading to Milwaukee, making their final pitches to voters. Joining us now is David Gura, host of Bloomberg's The Big Take podcast. David, with just days to go, it's perhaps more about getting voters out than changing anyone's mind. So what is the pitch at this point?
Yeah, it's just not to stay on the couch, to do what you need to do to get to the polls or send those ballots in. And you see these campaigns really doubling down on that and really targeting people at a pretty granular level. All the while, you have these kind of big celebrity-studded marquee events. So yes, they'll both be in Milwaukee tonight. Cardi B is going to be at Vice President Harris's event there. And so it's kind of continuing this theme that we've seen, that there's been kind of one big marquee speaker, a lot of musical acts, and that is just kind of to give this sense of excitement and importance, as all the while these campaigns are spending many millions of dollars, again, targeting specific voters and trying to get them out.
Well, to that end, how is the posturing changing heading into just 4 days left of this election?
They're both trying to showcase how indefatigable they are. Like, tirelessly crisscrossing the country. So I was in Wisconsin earlier this week. Lo and behold, they're back there again, and they're like back to Wisconsin via a swing through the Southwest and Nevada. So they're all over the place. They're trying to evince that as well. And so we've kind of gotten a sense too from them of what the final days of the campaign are going to be like. Kamala Harris is going to be in Pennsylvania on Monday before Election Day, going to 3 separate cities to hold big events there. So again, trying to cover as much terrain as possible and make no voter in any of those states, those swing states, feel like they've been ignored or left off.
One of the notable things about this time around is the huge gender gap that we're expecting and the historic nature of it. You can see that in some of the campaigning and the difference that's made between the candidates. Donald Trump, of course, saying that he was going to help women whether they wanted or not. How is the Harris campaign taking with this and running with it?
It's been a real gift for them. Early on in this campaign, they wanted the campaign to kind of center on the issue of reproductive rights and healthcare, and really wanted to target women. Now they have this comment from former President Trump. They're able to talk about it again. And so we heard that from Vice President Harris. And then Mark Cuban made another comment that kind of swung things the other way. So we're seeing just sort of how remarks can be magnified and can kind of reshape things. But you mentioned the role of women. And in Pennsylvania, we see that in those early votes that have been returned so far, 55% of them have been from women. And Kamala Harris's campaign is taking that as a really positive sign. And we know that white women in particular are a very reliable electoral bloc. 30% of the electorate, and so that's who both campaigns are really going after, trying to get them to the polls.
Yeah, it's down to bean counting at this point in time. And if we think about another topic here, you have both stock and bond markets and currency markets making their own bets as well. We're going to talk about election betting markets in a minute. What do we know about the election betting markets versus the polling at this point in time, especially when these other markets say something so meaningfully different?
Right, we have this wild divergence between both of them, and I think that's really fascinating. I'm eager to hear what your next guest has to say about that, but there are a lot of folks who are still quite critical of the way that polls are conducted and raising some skepticism that what we've seen, this kind of deadlock throughout the campaign, is reflecting how things are accurately. So I think betting markets are a conduit through which people who are skeptical or think they can kind of figure this out better than some of those polls can are expressing that. And I think, again, there'll be a postmortem after this election, after this campaign. It'll be interesting to see sort of which matched it, which didn't, and sort of what they told us that polls didn't.
Absolutely. Anytime you talk to anyone slamming the betting markets, they say, well, the polls don't tell us anything either. David, we thank you so very much. We hope you have a great weekend. 4 days until that election, and looking forward to all the coverage. And for more on the election, we are joined by Tarek Mansour. He's the Kalshi CEO and co-founder. Kalshi is the first federally regulated financial exchange for trading directly on events including the upcoming election. And it's interesting, even if you just look at the most recent movement, I'm really curious to know what's going on under the hood. If you pull up WSL Election Go on your terminal, you could see the convergence in particular. Tarek, what do you know under the hood about who on your platform is betting and why the odds are changing so much?
I think we had a little bit of an audio issue. So, well, a few things, first of all, the big thing that we should talk about is so Kalshi, just legalized election betting in the United States. So we're only for Americans. Only Americans can participate in Kalshi. And our odds right now are at 57% of a Trump win versus 43% of a Kamala Harris win. The odds move because the situation is dynamic. We've been saying for a few weeks now, at some point Trump got to 62, 63%, and people were really kind of freaking out on the other side. And we were saying, well, first of all, this is just a coin flip. It's slightly biased. These odds are not the same thing as polls, which we can talk about. And then number two, it moves. Every single 24 hours is a very long period of time from now till election day. A lot of news is coming in, votes are coming in, new information is coming in that is being incorporated by the market.
It's interesting. When you look at your platform versus others, I think this has been probably your largest thing you've had to confront in the last several weeks. This idea that on certain platforms, Polymarket, for example, actually, you see certain whales really being a large part of the trade. And therefore, when you look at pricing on your platform versus others, you see a massive divergence. What do you make of this idea that there could be a lot of whales in this market, particularly ones that don't even live in the United States, that might look to skew what's going on out there, whether it's in the market or what's on the ground?
Yeah, absolutely. Well, first, it's very important to differentiate. So Kalshi is the first legal and regulated prediction market or election, market for people to trade or bet on the election in the United States. So, I can't talk much. I don't know what's going on. So PIMCO is an example, but there are crypto offshore, unregulated markets. So they're operating outside of the bounds of the law. And in those markets, anything could happen. You could have manipulation. There was a report, it seems like on Bloomberg and Fortune recently, that there's fake volumes and wash trading on these types of platforms. What you know for certain on Kalshi is none of this stuff is happening. It's a regulated market onshore that is legal for Americans, and it's only accessible for Americans. And so what we see on our markets is not actually indicative of whale behavior. There are actually more bettors on Trump than on Kamala Harris. That's number one. And number two, actually the average trade size, the average bet size on Trump is slightly smaller than it is on Kamala Harris. So this notion that it's a few whales that are pushing the prices, while it may be true on unregulated, illegal offshore markets, it is not true for our regulated venue that is regulated at the federal level.
Tarek, what do the demographics look like of those who use Kalshi? What does a typical user look like? Does it skew a certain way that also maybe skews what the popular bets are?
Yeah, so it's a great question. And I will say two things to that question. So first, demographic is tilted male. So 90% of our customers are male, 20% is female. Now, the thing that's really important, and we release all this data publicly, so we're all about transparency. We want people to see. Actually, a higher percentage of females are betting Trump than they are than the percentage of males that are betting Trump. So I don't think that this actually skewed towards male. If it was 50-50 male-female, it would actually change the odds much. That's just purely from a gender perspective. On the age group level, the percentage of people that are betting Trump versus Kamala is exactly consistent across all ages. There's no difference. But the second thing I will say is, even if there is a skew, this is the beauty of these markets. When you have money on the line, one thing we can trust about the American people, really any people, is that they will be greedy. People like making money and they hate losing money. And so if there is any bias, then there is a multi-tens of millions of dollars incentive to adjust that bias. For traders, arbitrators, people that see that bias and come and trade against it, bet against it. If you believe it's biased, you should bet against it because that means you're going to make money. And so that's why these markets are so powerful, and they work on average better than polls that can be biased, where there's no money on the line. People can lie, people can just not respond, and so on and so forth.
To that point, when we look back at this after the election, I know that this is a big if, and we know the results. This, as you say, is a historic time, not just for you, but for the betting markets, the first legal betting that you can have on election. How will we look back at Kalshi and understand its usefulness in not just betting on the election, but understanding the evolution of averages of the election and who was likely to win?
So that's a great question. So first, what I will say is you have to let these markets play out a few times, right? This is probability, right? We are saying there's a 60% probability or 57% probability that Trump will win. That may move from now till the election. But the thing that's really important to understand is if Trump wins, that does not mean that these markets are a crystal ball that can see the future. And if Harris wins, that does not mean that these markets are flawed and they don't work. 57% chance of winning is not 100% chance of winning, and 43% chance of winning is not 0% chance of winning. 40% chance of winning is basically you're playing a football game and you're one touchdown behind. That's not a huge deal. That's still very close to a coin flip. It's just a little bit of bias. And I keep repeating that to people. This is not a polling method, right? If you're up 60% in the polls, you're most definitely going to win.
Tarek,
this is just saying there's a 60% chance of that happening.
To that end, because of how popular your betting site and others have gotten, how would you respond? And this is, of course, looking across the horizon. This is a lot of ifs, too. But how would you respond if your site or sites like yours are used by the Trump campaign as evidence that an election was stolen if he loses?
Yeah, so to the point, the market has become very large. I mean, that was the point. We always knew we legalized the markets. It's the first time it's legal in 100 years. And, within a few weeks, we're #1 on the App Store for finance now. And we overtook TikTok, Instagram, and a few other apps in a short period of time. That's how much demand and how many new customers are coming to this. So it is big. And it should be indicative of where kind of things land. What I will say is any financial service, but really anything, any new financial technology or technology in general can be used in variety of different ways, for good, for bad, for a variety of other reasons. We cannot concern ourselves with this. We have to think long term. we're doing the right thing. I think this is an alternative to polls. I tell people, look at polls. You don't need to replace polls with our markets. This is an additional source of data and information. And now we're providing an alternative for people to polls or pundits and so on. And people can look at all of it all together and make their own informed decision. How people use these markets and how they interpret them, that's really up to them. We're just going to focus on developing great customer experience for people and, staying focused on the forecast leading to the election.
Tarek, this has been so interesting. Please come join again after the election. Let's see how it all shakes out. Tarek Mansour of Kalshi. And on Tuesday, Joe Matthew and Kaylee Lines, they will have a 2-hour Balance of Power special to kick off the election coverage. And then I will be with the team for Bloomberg's Election 2024 special. That begins at 7 p.m. in New York, runs all night. Stay with us for that. But first, coming up next, Columbia Law School professor Kathryn discusses how the next president could impact the finance industry. We'll have that for you on Open Interest next.
And it's time now for our daily Wall Street Week conversation. With the election just days away, how will the next president affect the economy? David Weston spoke with Columbia Law School professor Kathryn about the Fed's independence from the commander-in-chief.
Donald Trump has said that being the Fed chair is the best job in government. It is at least possible that under a second Trump presidency, it might be the worst job in government. I mean, some of his biggest economic initiatives, higher tariffs, really limiting immigration, would have an inflationary impact. We know going back to 2019 and early 2020 that he was very vocal with his frustration that Chair Powell at that time had interest rates where they were. He wanted them to be lower. And so you can imagine a scenario where we're facing significant inflationary pressures and prices are going up, but a Fed chair has a hesitancy in really tightening interest rates and tightening monetary policy in the way that would be necessary to combat the inflation, because doing so might lose the faith and the backing of a second President Trump. So it's an interesting dynamic to watch.
Is the independence of the Fed really at issue? Initially, we heard some things out of Donald Trump or people around him saying maybe they would change who the chair is and they should consult the president before they decide. He's backed off of that now some, but is it really at issue?
He's backed off of it right now. I don't think it's going to be the issue that we're going to see right after the election. I think there is going to be an effort to maintain the status quo, to maintain faith in the dollar. And when we do have a global dollar-based system that Trump is very protective of and really wants to support, without faith that the Fed is going to provide swap lines, for example, to foreign central banks, should it become necessary, and if those decisions became more politicized, that could do real damage. But I think in the short run, there's going to be a lot of effort to protect it. But again, I think the question is he going to be willing to be patient if he's implementing policies that really would lead the Fed, if it's acting independently, to adopt a more restrictive monetary stance than he otherwise wants to see. So I think tensions could emerge over the course of 4 years.
The job of being chair of the Fed may be very difficult over the next 4 years for reasons you described, but let me suggest another one, and that is the debt and deficit, and the chances that might actually affect the Treasury market. That's going to put a lot of pressure on the chair of the Fed and the Treasury Secretary as well, because you could have a real crisis there.
Yeah, no, you really could. And there's two different issues that are at play, both of which are quite important. One is just who's the marginal buyer if we need to issue more treasuries? Are we going to be able to continue to fund the deficit without a significant increase in the cost of doing so? And that's both a byproduct of interest rates, but also kind of what is the spread that the market's going to demand, because there's just so much volume out there. The second challenge with the aggregate volume of treasuries outstanding is the infrastructure for trading treasuries hasn't fully kept pace. We saw that, unfortunately, all too clearly in March 2020, where there was meaningful dysfunction. The Fed came in and started buying, and that helped to calm markets. There have been meaningful reform efforts since that time, but there's reasons to be concerned, particularly if you do have a significant increase in the deficit, that infrastructure wouldn't be able to handle another shock.
That was Columbia Law School professor Kathryn and David Weston joins us now. David, such a fascinating interview. And I'd say one of the things that I came away with was some of her skepticism and uncertainty. Did you come away with any idea of whether this American financial system could handle, as she pointed to, some of the shocks that may come in a Trump 2.0.
Yeah, I wouldn't say that Kate says it couldn't handle it. That would be pretty alarming. But she said there may be some real stresses and strains put on it. In part, you heard there, in part because of some of what Donald Trump is proposing as policies. And you see that in the marketplace, actually. I mean, a lot have thought that interest rates will go up under a Donald Trump because, in fact, there'll be more borrowing and there could well be more inflation. Tax cuts will tend to be inflationary, and certainly tariffs. Everybody's very concerned about the tariffs issue.
People are also really concerned, depending on who you are, I suppose, but of the Fed independence issue. That's kind of where she started here. Of course, if he does win the presidency, instead of rates going up, he would love them to go down. And so how concerned was she around the Fed's independence?
Well, as she said, there's going to be a lot of tension. She actually focused on the number 2 position, the vice chair. She thinks that's going to be the target for Donald Trump, that is basically responsible for regulating the banks. She thinks there'll be a lot of pressure on that. And of course, during the next term, if it is Donald Trump, there will be the question of Chair Powell's term, which will come up, and who gets appointed to replace Chair Powell if, in fact, he doesn't get renewed. So that all could affect profoundly sort of what we all do every day, right?
There's this really interesting study from Lori Calvasina of RBC, and she went to all of her analysts and basically said, tell me what the #1 issue will be under a Trump presidency. They all put deregulation at top of the ticket. I know you talked to Kathryn Judge about this issue of deregulation specifically for financials. What sort of environment did she see going forward?
Well, on the one hand, she said, don't get too over concerned about it, because she said if you look at what happened under the first Donald Trump presidency, he didn't deregulate nearly as much as people thought he was going to, or maybe as much as he thought he would. And if you look at President Biden, he didn't regulate as much. I mean, the fact is, there's a huge infrastructure in Washington that involves courts and regulatory agencies and Congress that really argues against changing quickly how much regulation there is. But I'll just add one other thing. In addition to talking to Kate Judge, we also talked to Josh Bolton, who runs the Business Roundtable. You know, he talks to all the CEOs of the big companies. He did say deregulation is way up the list of priorities for corporate executives. That is something they really hope to see. They think there's too much regulation, and it's holding back growth, basically, is what they would say.
David, looking forward to the show tonight. It definitely speaks to what I love to talk about most. Our thanks to Bloomberg's David Weston. Remember, you can catch Wall Street Week every Friday at 6 p.m. Eastern. Don't forget to tune in tonight. We'd also love to hear from you and what you think about our shows here on Bloomberg. We appreciate your feedback. There's a code on the bottom of your screens to participate in our survey. Take your phones out, take a look at it, let us know. This is Bloomberg. Let's get a check on these markets. A little bit of a tear for you into the weekend. We're watching the S&P 500 up now 0.7%, coming off of that tough October we had. NASDAQ 100 still up about 0.8%. Danny, my breath is taken away every time I look at that 10-year yield. It is now not only above 430. Did I just see 432?
Yeah, I mean, the first reaction off after a very weak jobs report was to trade it at face value. But then it is a report that is mired in so many issues. So we looked forward to the ISM. I don't think it's controversial to say that this is tier 2 data, that this isn't top of the pile data, and yet it is a market that is willing to sell off bonds in reaction to it. It gives you a sense of just how edgy this market is into a really event risk-filled week next week.
Oh, totally. And we're going to talk more about that week in just a second here. I will say you do actually have the 2-year still down about a basis point, so the differential is pretty fascinating. But we're going to also turn our eyes here to a different part of the stock market. Of course, that's the ETF market. BlackRock has filed to create an ETF share class or share classes of its mutual funds, a design that could bring tax advantages to billions of dollars of new assets. It's an attempt to replicate Vanguard's successful blueprint, and it's pretty fascinating because this multi-share class fund for Vanguard had expired. The patent had expired in 2023, and so 33 new managers have asked the SEC for permission to recreate the model. This is, of course, according to Bloomberg's Katie Greifeld, and Emily Graffeo follows this very closely. Sounds a little arcane, but But the interesting thing about it is you know that billions of dollars of savings comes from that tax advantage.
Right. And look, just tax advantage strategies are so popular. I know AQR and Cliff Asness also has been really promoting a tax loss harvesting type strategy. The criticism for that had been if it's at a hedge fund level, it's not accessible to the normal person. It's just something for the very wealthy. So having an ETF that can do it is powerful. And you can see why others would want to replicate it.
And you can see the head of U.S. iShares does say at BlackRock that it introduces a new avenue for choice for clients to the extent that you're saying you can't just invest in a hedge fund, right, for those tax advantages. You need it in the ETF structure too. But another fascinating thing about this for me as well is it also kind of speaks to that continual movement you've seen away from mutual funds and into the ETF world.
Yeah, except active ETFs have done really well this year too. Maybe again, it just speaks to the volatility of this moment and that we're going to continue to have and the difficult to navigate it.
And Danny, just 4 days till that election. We have a busy week ahead. Coming up on Open Interest on Monday, we have Compass CEO Robert Refkin joining the C-suite, plus market analysis from Citigroup's Stuart Kaiser. Could get choppy out there. Stick with us. Have a great weekend in between. This is Bloomberg.